In a span of 48 hours, silver went from trading like a sleepy industrial metal to printing numbers that looked like a typo, around $120 an ounce. Then, almost as quickly, it bled back toward the kind of prices people associate with panic, not prosperity. The kind of move that normally takes years of inflation, shortages, and monetary stress happened inside a single news cycle. And the strangest part wasn't the spike. It was what changed right after the spike, and what that change quietly forced thousands of market participants to do. Because if you zoom out, the price chart is only the front page. The real story is hidden in the plumbing, margin tables, risk classifications, the quiet decisions that determine who can stay in a trade and who gets pushed out, not by being wrong, but by not having enough collateral at the exact wrong moment. And in the silver shock, a lot changed fast. Welcome to Signal and Noise, where we decode what matters before it becomes dinner table conversation. If you've been tracking silver, gold, and the way policy decisions ripple through markets, you already know the headlines are rarely the whole story. Consider this your invitation to think like the people who move size, not like the people who chase candles. If you find value in that perspective, stay close. And tell me where you're watching from, because these market moments don't land the same way in every place. Now, let's reconstruct what actually happened. In late January, silver accelerated into a parabolic move that caught the attention of everyone from commodity desks to social media. The metal surged into triple digits, hitting the neighborhood of $120 an ounce at its peak. That is a level that forces comparisons. It drags up memories. It pulls old charts out of drawers. And it creates a new kind of pressure, the pressure of leverage. Futures markets are built on leverage. That's not a secret. A trader doesn't post the full value of the contract. They post margin, a good faith deposit. That deposit is supposed to cover typical price swings. But when price swings stop being typical, the exchange has a problem. The exchange must protect the system from default. And when the exchange acts, it doesn't do it with a press conference. It does it with a notice, new margin requirements, new risk parameters, new collateral demands. After the historic spike and the violent reversal, the Chicago Mercantile Exchange raised margin requirements on precious metals. Silver margins for standard risk profiles rose from roughly 11% to about 15%, and higher for heightened risk classifications. That sounds technical, so translate it into human terms. If you can't pay, you don't get to debate the reasoning. You move out. In markets, moving out means selling. This is the central mystery. When silver was screaming higher, who had to sell into that strength? And when the rules tightened, who was pushed out right when volatility peaked? They rearrange ownership. They transfer exposure from weak hands to strong hands, from undercapitalized to well-capitalized. And that's where the title question comes alive. Emergency meetings, plus a silver spike, coincidence or control, not control in the cinematic sense, control in the mechanical sense, the control that exists whenever a system can change the collateral rules that decide who gets to participate. To see the pattern, you have to look backward. Silver has done this before, in different costumes, with the same skeleton underneath. In 1980, silver's famous blow-off top wasn't just about scarcity or inflation. It was also about leverage, position concentration, and the response of the trading venue. Margin changes and position limits became part of the narrative, and the result was a break that rewrote fortunes quickly. In 2011, another surge took silver into the neighborhood of $50. Again, the move didn't end gently. It ended with a cascade that made it clear how fragile a leveraged market becomes when volatility climbs. In 1980, the metal ran, headlines intensified, and then the system tightened. Result, a cascade that punished late leverage and rewarded whoever could survive the collateral squeeze. In 2011, the pattern repeated with modern speed. Result, a sudden reversal that made the chart look like a cliff. In 2026, the same architecture showed up again, but with a sharper, more surreal headline number. The playbook is not that prices can't rise. The playbook is that when they rise too fast, the infrastructure responds, and that response becomes the second catalyst. Now consider the players. The first is the exchange itself, because the exchange is not a spectator. It is the arena. It sets the entry price for leverage. It decides what safe means at any moment. When the exchange raises margins, it is saying the system now demands more collateral per contract. That immediately increases the cost of holding positions, especially for anyone using leverage as their engine. The second set of players are the clearing members and brokers, because they are the ones who pass margin requirements down the chain. A margin hike at the top becomes a margin call at the bottom. Some firms, seeing volatility, demand even more than the exchange minimum. That is how a risk event becomes an avalanche. The third set is the large funds and institutions that can either provide collateral without blinking or reduce exposure. They are not immune to losses, but they are less likely to be forced into bad timing. Then there's the broader macro backdrop, because silver does not trade in a vacuum. During the same shock window, the US dollar strengthened, and mainstream commentary tied part of the pressure on precious metals to that dollar move, and shifting expectations around central bank leadership. When the dollar rises, it often acts like a headwind for commodities priced in dollars, not because the metal changed, but because the measuring stick did. And then there is the fourth player, the public narrative. The narrative is powerful because it attracts flows. When people see silver at 120, some chase, some hedge, some panic. But narrative doesn't post margin, collateral does. The market does not care how compelling the story is when the account balance is short. Here's the part no one is discussing loudly enough: dislocation. Silver spot headlines, futures swings, and the behavior of paper proxies did not move in a clean, unified way. One of the clearest examples was the iShares Silver Trust, often used as a liquid stand-in for silver exposure. In the chaos, it recorded a single-session collapse on the order of 28%, landing around the mid-70s. In other words, while some people were still anchored to the triple-digit headline, a major paper vehicle was already showing how quickly the market was repricing risk. Dislocations like this matter because they reveal stress. If everything were smooth, the proxies would track neatly. When they don't, it tells you about liquidity, about timing, about who can transact and where. It tells you that in a fast market, the path you take to silver exposure changes the outcome dramatically. Futures trade differently than ETFs. Physical trades differently than paper. And when volatility is extreme, those differences become visible. There's another layer to the dislocation that most people miss because it isn't visible on a simple chart: the difference between instant liquidity and real-world delivery. Futures contracts and ETFs are designed to move size with a click. Physical metal is not. Bars have serial numbers. Vaults have operating hours. Transport and insurance exist in the physical world, not in a trading app. In normal times, those worlds stay connected through arbitrage. In stress times, that connection can stretch because the easy trade becomes an operational project. When a futures price spikes, it can reflect several forces at once: aggressive buying, short covering, and options dealers hedging. Modern markets contain large systematic flows that respond to volatility and momentum, not to stories. When price rises fast enough, those systems can become forced buyers. When price falls fast enough, they can become forced sellers. That reflex is a big part of why the move felt so impossible and then felt so brutal. Silver is especially sensitive to this because it wears two identities. It's treated as a monetary metal in the public imagination, often grouped with gold. But it's also an industrial input tied to manufacturing cycles and supply chains. In a chaotic window, both identities are on stage at the same time, pulling in different kinds of participants who speak different languages and trade different instruments. Now, bring it back to leverage in concrete terms. A standard silver futures contract represents thousands of ounces. That means a $1 move isn't a $1 event. It's a move multiplied by the contract size. When silver jumps tens of dollars in a day, the profit and loss swings can overwhelm accounts. The exchange doesn't need anyone to be wrong for risk to rise. Volatility alone can create default risk if collateral is insufficient. That is why margin exists. But shock absorbers can become springs. When margins rise abruptly, the trader who was within limits on Monday can be outside limits on Tuesday. The broker calls. More cash is required or exposure must be reduced. That reduction isn't driven by conviction. It's driven by survival. Multiply that across brokers and accounts, and you create a wave. That wave is what price charts translate into a plunge. This is also where the phrase heightened risk profile matters. Exchanges and clearing firms classify participants. They look at concentration, liquidity, and overall market climate. Two traders can hold similar contracts and face different collateral demands depending on how they are categorized. In a stress event, reclassification can happen quickly. And when it does, it can feel to the participant like the rules changed mid-game because they did. Now look at the institutional side. Large participants often have collateral pools, credit lines, and treasury operations that can move funds rapidly. They also have risk systems that reduce exposure before the public notices anything unusual. If volatility spikes in off hours, an institution can adjust within minutes. A smaller participant might only find out when an automated margin notice arrives. That is the information asymmetry that matters. Not secret knowledge, just faster visibility into the plumbing. That asymmetry shapes behavior. When markets are calm, everyone looks competent. When markets turn violent, you discover who was financed by confidence and who was financed by cash. The funded participant survives. The underfunded participant becomes liquidity for someone else. This is why emergency meetings aren't just a dramatic phrase. They describe how risk management actually works. When volatility explodes, desks meet. Clearing firms meet. Margin teams meet. Decisions are made in real time about how much exposure the system can tolerate. Those decisions, written into collateral rules, can move markets as powerfully as any headline. And it explains why paper versus physical becomes more than a slogan during moments like this. Many participants trade futures with no intention of taking delivery. They hedge, roll, and close. ETFs can reprice instantly, but their mechanisms still depend on balance sheets and operational capacity. Physical demand can surge in the real world at the same time, yet it cannot be met or moved instantly. When dislocations appear, arbitrage usually closes gaps until the risk of doing so rises. In that window, gaps can persist longer than expected. Now, let's stack the evidence in a way that strips emotion out of it. First data point, the peak. Silver's move into roughly $120 an ounce in late January is the catalyst, the spark, that drew attention and pulled leverage into the story. Second data point, the reversal. Prices plunged, at one point printing levels in the low 70s intraday before stabilizing higher. That is not a normal pullback. That is a liquidation event. Third data point, the margin shift. The exchange increased margin requirements, lifting the collateral burden from around 11% to about 15% for standard classifications and higher for accounts deemed higher risk. Fourth data point, the proxy shock. SLV's sharp one-day fall, around 28%, showed how quickly paper exposure could reprice when the market was trying to find a new equilibrium. Put these together, and a picture forms. The market created a volatility spike. The volatility spike forced risk managers and exchanges to respond. The response demanded more collateral. The collateral demand forced some holders to reduce exposure. Forced reduction amplified the move down. And that down move, in turn, justified the original risk response. It becomes a loop, a feedback system. Here's a subtle detail that makes these loops even stronger. Collateral is not just money, it is time. When margins rise, some participants can meet the call instantly because their assets are already in the right form, in the right place, and approved by the right clearing process. Others might have wealth but not liquid collateral. They may need to sell other holdings, move cash between accounts, or wait for wires, all while prices keep moving. In a fast market, hours matter. That clock is ruthless. That is why volatility events often spill into other assets. If a trader needs collateral, they sell what they can, not what they want. That can pressure equities, bonds, or other commodities in the same window. Then correlations jump, not because fundamentals suddenly align, but because financing forced synchronized behavior. That distinction changes how you interpret the tape. And once that collateral scramble ends, the market can look calm again, even though ownership has changed hands. That's the reset phase. It's quiet, it's boring. And it's where the next large move is usually prepared, out of sight by the people who stayed funded. This is not a conspiracy, it is a mechanism. And mechanisms have predictable outcomes. When the cost of holding leverage rises suddenly, the most leveraged participants become sellers, not because their thesis changed, but because their financing changed. That selling pressure can overwhelm fundamentals in the short term. In the long term, it often clears the market, resets positioning, and sets the stage for the next phase, whatever the underlying supply and demand actually are. To make it simple, think of a crowded theater. Everyone is comfortable. Then someone shouts, "Fire!" Whether there's a fire or not. The exits don't change. The width of the doors doesn't change, but the speed of the crowd does. People bump, some fall. Now imagine, in the middle of the stampede, the theater management narrows the doors because it wants to reduce chaos. That might sound like safety, but it can increase pressure at the exit. Margin is that doorway. In calm times, it's wide enough. In panic, it's suddenly narrower and the crowd is bigger. So what about the emergency meetings part of the title? In fast markets, emergency meetings happen in layers, exchange risk committees, clearing firm risk desks, treasury teams deciding how to move collateral, regulators monitoring systemic exposure, bank executives reviewing cross-asset correlations. But the system behaves as if meetings are happening because decisions are made quickly. Rule changes are announced, liquidity thins, and the market tries to discover a price while the rules for holding that price are changing. That's why the timing matters. When margin changes arrive after a surge and during a fall, they can be interpreted two ways. Some will say, necessary risk management, protecting the system. Others will say, a pressure valve that conveniently forces weak hands to capitulate. Both views can exist without either requiring secret coordination. The evidence is the timing, and timing is what traders live and die by. Now let's address the contradiction that keeps attention locked. If silver was so strong, why did it collapse so violently? And if it was a bubble, why did it reach those levels in the first place? Here's what the data suggests. The spike was not just about belief. It was about structure. A market can move farther than fundamentals justify when positioning and leverage align, and it can fall farther than fundamentals justify when the financing of that leverage is pulled back. That's why expert commentary split. One camp looked at the dollar strengthening and said the move was a classic risk-off. Liquidation. Momentum chasing met a macro headwind, and the unwind did what unwinds do. Another camp looked at longer-term narratives around supply constraints and demand flows and said the drop was a mechanical event, not a fundamental one. The contradiction is real because the time horizons are different. Short-term price is often about positioning. Long-term price is about balance, and dislocation is the bridge between them. When paper vehicles diverge from headlines, when intraday prints whipsaw tens of dollars, when collateral requirements jump, you're watching the system negotiate. It is the market admitting, we don't know the price yet, and we're going to find out in public. So what does this mean going forward? Historically, episodes like this tend to lead to one of three paths. The conservative path is stabilization. Volatility fades, margins remain elevated for a time, and silver trades in a new range as participants rebuild positions more cautiously. The moderate path is a retest. After the forced selling clears, the market attempts to reclaim lost ground, but does so with more friction and less leverage, producing a slower grind rather than a vertical sprint. The aggressive path is renewed stress. If the underlying drivers that fueled the spike remain and new catalysts appear, whether currency moves, policy shifts, or physical demand pressures, then the system can experience a second wave, where the first move becomes a preview rather than a finale. Historically, when the first wave includes forced liquidations and rule tightening, the second wave is often more selective. It rewards patience, not speed. It punishes those who assume the first chart is the only chart that matters. Notice what's missing here. Certainty. Markets don't hand out certainty. They hand out probabilities. And the indicators are not mystical. They are observable. Watch volatility. Watch margin updates. Watch whether proxies track cleanly or diverge. Watch the dollar's trend and how metals respond to it. Watch whether the market's rebounds are orderly or frantic. Now step back and look at the human divide. In every market episode like this, there are two groups. One group sees only the chart and the headline. They arrive late, act fast, and get whipsawed by the system's mechanics. The other group watches the mechanics first. They track collateral, liquidity, and rule changes. They understand that the market is not just a price. It is a process that determines who can hold exposure over time. It's not about being smarter. It's about paying attention to the right layer. Because the information gap becomes a wealth gap, not through magic, but through timing. Institutions move first because they see the plumbing. Retail moves last because they see the headline. And in a margin-driven unwind, the last mover is the one most likely to be forced to move. So when you hear emergency meetings and you see a silver spike, don't ask only whether it's coincidence or control. Ask what levers exist in the system and how those levers were pulled. Ask who benefits from higher collateral requirements at the peak of volatility. Ask who can provide liquidity when others cannot. Ask why paper proxies sometimes reprice differently than the story being told on television. The answers won't be a single villain or a single hero. The answers will be structural, and that's the real takeaway. The most important events in markets are rarely announced with sirens. They are announced with small numbers in a margin table, with a notice buried in the machinery, with a quiet reclassification of risk. Those are the moments that shape outcomes. This is signal and noise, where we decode what matters before its headlines. If this connected dots you hadn't lined up yet, stay close, because the next time the market moves like this, it won't feel like a surprise. The question isn't whether volatility returns. The question is whether you'll recognize the mechanism before it does.